And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is the official start to the June Fed meeting today. Nothing's going to happen today. It'll be tomorrow. Tomorrow's the second day of the meeting. That's when they'll have their announcement, the press conference, and all that. But markets are going to be just kind of treading water most likely today, just in anticipation of that meeting. Again, it was just markets really haven't gone much anywhere. We'll talk about that in a minute. But this week is both the inflation data as well as the FOMC, and the FOMC will have that data. So what will the Fed do? We'll talk about that, obviously more on Thursday with Michael Leibowitz when he's here. But for really between now and that announcement, really not so much the announcement, it's going to be the actual press conference with Jerome Powell that the market will respond to, because everybody's just waiting. Has the Fed changed their stance? Are they going to not cut rates? Are they going to potentially hike rates? This is going to be the big story. No longer does it matter anything about fundamentals. It's all about what the Fed will do. That should be the new name of the show. What will the Fed do every day? Just what's next for the markets? Want to know? Just go for the Fed. But no, that's pretty much been the case. Today's article on the website. There's been a lot of conversations talking about the market today versus the way it was back in 1999, those dot-com comparisons, look at NVIDIA versus Cisco and, kind of all those things. There's some big differences today versus 1999. A lot of these companies today, massively profitable versus back then. But there are some similarities. And we go through some of those similarities in today's article. It's on the website right now, realinvestmentadvice.com. The biggest similarity, though, is that back in, and it's funny to say this because when Brent and I first started working together, and this was kind of mid-ish 2000, we started working together on the radio show. And at that time, there was another radio commentator at that point in time talking about every day. It was like, fire your stockbroker. You don't need a stockbroker. Just buy ETFs. And, of course, there was only 3 ETFs at the time. It was the NASDAQ, the triple Qs, the spiders, and the diamonds. That was it. But the similarity, though, is that at that same time, there was also a lot of index mutual funds. And ETFs really hadn't come into their own yet. They were coming. It was just kind of that kind of industry was just really getting started. But mutual funds were still a big thing back then. There was a lot of S&P 500 index type mutual funds or index tracking funds. And all those managers were being forced to buy the biggest stocks in the index because they had to keep up with the index, right? They had to remain matched to the benchmark. Well, fast forward to today, 38% of the S&P 500 is basically dominated by 10 stocks. So all these managers, and we now have multitudes of ETFs of all different types. There's 400 roughly ETFs that own Apple, right? So every time Apple does something, they've got to go out and buy more Apple if Apple goes up in the index. So as these top 10 stocks continue to migrate higher and higher, and particularly we're talking about NVIDIA right now, that requires more and more buying by all these ETFs, et cetera, being kind of force feeding these stocks to go higher. Well, the risk to that, and this was the same risk that occurred back in 1999, was the expectations of growth, right? The markets were pricing in massive expectations of growth for these stocks that, the internet was going to change the world, which it did. But it never created the profitability that everybody thought it was going to create back then. It did create a lot of profitability, don't get me wrong. It just wasn't the mountains of profitability that everybody thought was going to occur. So that disappointment. So as everybody piled into these stocks and these prices and the stock prices went higher and higher and higher, ultimately the disappointment of reality versus expectations caused that reversal in price to realign valuations with reality back in 1999. We're seeing a lot of the same things today. We're seeing an exponential growth trend of AI productivity going forward. Apple said a very interesting thing yesterday during their reveal. They have now integrated AI into their kind of suite of consumer products, but they said, we're going to be using AI to give consumers access to the data that they want, right? Not just everything. And so they're tailoring AI to provide a better product. And this is a little different take than what everybody else is doing with AI, which is this massive, overtake of AI into everything. So again, we'll see what happens with AI, but there's a lot of expectations. This is cause a massive increase in productivity, profitability, everything else is going to really benefit from this. The question will be, will it actually generate that profitability? Will AI deliver products that people actually want to buy and spend money on? And will they have jobs left to have money to spend with is going to be the bigger question. But that's going to be the question. If this piling in of money by ETFs into these top 10 stocks, if in the future those realities of AI don't come to fruition, that's the big risk. So anyway, that article is on the website right now. Here's what you need to know before the bell. Again, market really hasn't done much. Since we had that big up candle day several days ago, market set an all-time high, everybody was excited. Markets have really just done nothing for the last few days. And in fact, really, if we go back and look at this kind of entire move over the last really 3-4 weeks, the market really hasn't done a whole lot. We've kind of really just continued to grind sideways. We are back on a buy signal. But again, right now the markets are on hold here for the next, 48 hours until we get through the Fed meeting. And again, see what they're going to announce. Because again, this market has become so sensitive to every move. The market wants the Fed to cut rates. The only question is when will we cut rates? So if the Fed comes out tomorrow and says, hey, QT's on the table for July, rate cuts on the table for September, I'm just, whatever, that's going to be very beneficial to stocks. If the Fed comes out much more hawkish, we're not seeing evidence of inflation coming down. We're on hold indefinitely for cutting rates. That's not going to be good for markets. So again, this market could very well move down sharply or up sharply, by tomorrow afternoon. We'll just have to kind of wait and see. But again, right now, markets are going to be on hold until we get to that announcement because again, that's all the markets are really looking at the moment. One other thing to look at here is that if you take a look at crude oil as an example, speculative bets on crude oil have now gotten extremely negative. In other words, a lot of traders are not long crude oil, and crude has been making a very quiet little uptick here lately, and we're just now triggering a MACD buy signal from a fairly low level. That should give oil stocks a little bit of a lift here. So again, we kind of got very suppressed on oil prices. There's a big deviation again between kind of oil prices and economic activity at this moment. So that's, and we're starting to move into obviously the summer driving season. We've got hurricane season coming up. So again, we've got the OPEC report out today as well. But again, there is enough room now, and speculative bets on commodities, on oil commodities in particular, are so negative that potentially provides fuel for a decent move higher here in oil prices over the course of the next month or so. So, getting back up into that $80 range would not be surprising at all, particularly with a MACD buy signal from a fairly low level. That kind of really gives oil a little bit of room to run here. So oil stocks may actually get to benefit over the next month or so in the markets as well. So a little bit of a rotation. All right, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn. Got a few client questions that we're going to kind of go through today. Questions that we've been getting from clients and prospects as well. We'll talk about those with you this morning right here on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. John Penn joining me. Good morning, John. How are you?
Good morning. Great. How are you?
Doing well. Doing well. We've got a few client questions to go through. But before we get into that, I just wanted to talk about this Wall Street Journal article real quick that came out a day or so ago. Because we talked about on the show a lot about, the issues with colleges today, college education, and one of the big things that, we've done, one of the things that we did back in the 60s and the 70s and really even the early 80s is we kind of really gave blue collar work kind of a bad rap, right? We were all told our daughters when they were growing up, you want to grow up and marry a doctor, a lawyer, or a stockbroker. You don't want to marry a guy. You don't want to marry a plumber, right? And so we really kind of look down on blue collar work as not as something to aspire to. You needed to go to college and get a college degree, go work for a big company, et cetera, get your pension and all that. Well, ironically, and this is always the part, the problem with education, as that we've talked about before, is that, in the 1940s, most people had an 8th grade education. And if you had a high school education, you were a genius. So, because most people didn't go to high school, they graduated 8th grade, they went to work on the family farm, whatever it was. Then in the 70s, we started requiring everybody to go get a high school education. So now we had everybody with a high school diploma, which you have too much supply of those diplomas. So those didn't carry any weight. So then you were supposed to you need to get a college education. And if you had a college education, you were kind of a rare breed at that moment. And because there weren't that many, everybody had a high school diploma, but nobody had a college education. Well, after the Obama administration basically nationalized college education through the student loan program, now everybody's going to school. Everybody's got a college education, and there's no value, right? It's supply and demand. And what's interesting is that now this younger generation, the Gen Zs, are now coming to the realization that college doesn't have the benefit. Going to college doesn't have the benefit. What does have a benefit is blue-collar work. And it's funny that we're now making that transition. There's a lot of talk in the media about trade schools, going to school, getting instead of going to college, go get a trade. And there was a great article in the Wall Street Journal. Gen Z plumbers and construction workers are making blue-collar cool again. And it's with a little bit of a different twist, though. Talking about, and particularly Lexus, who is, she is 25. She is a electrician, and she does this electrician work on big construction projects, etc. And she's been posting her work on YouTube and on TikTok, and she's got 2.2 million followers, and she has got a lot of people interested in an electrician. But she also, by the way, makes an extra $200,000 a year off of TikTok for posting her videos.
Yeah, it's not too shabby.
But as funny is that she's now got herself in the position that she can't quit working as an electrician because then she needs the content to feed her TikTok channel, which makes her the bulk of her money. So,
wasn't there a movie about this in the 80s? Flashdance? The chick was a welder.
Yeah, she was a welder and then a dancer.
Then she was a dancer, yeah.
Right, but it has nothing to do with...
She didn't have social media.
This has nothing to do with that, Brent. Just go back to your corner.
Okay, I'm over here.
So, good try, though.
We have some thick skin in here, folks, this morning.
But it's interesting, though, is that now it is just... I think this is good, right? The fact that she makes extra money on TikTok is great. I'm more kudos and more power to her. But I think it's good that she's also getting out this idea saying, hey, look, blue collar work is not this bad thing. And as we talked about here before on the show, there is a huge dearth of workers with trade skills, being an electrician, being a plumber, being a construction worker. Those are skills that we have minimized to a great degree in the country. And that's why when you call your plumber, you just know that there's going to be a big bill coming at the end of that because, back, when I was growing up, everybody could fix their own plumbing. I mean, everybody knew how to do basic plumbing. Everybody knew how to do basic electrical work. You didn't call anybody, right? I remember growing up, my dad was like, hold the light here, son. And of course, you yelled at for not holding the light exactly where he wants, hand me the wrench. And,
give me the snake.
Yeah, exactly. And that's the way it was. Everybody did. Well, today, those skills are very few and far between. And it's good now that we're actually starting to kind of shine a light on it because we talked about in our article on our website last Friday, if this power generation for AI comes to fruition, and we do need all this power that we are going to need to fuel this AI growth, we do not have the workers in this country to do the construction build out of that electrical grid. So there's going to be a huge demand of high-paying jobs to do that. And from that, I mean, the great thing about being an electrician and plumber, et cetera, that's a great, you go learn the trade, you do it, then you start your own business. And, I know many, many, many individuals that are electricians, plumbers, own their own companies, and they do very, very well for themselves.
And welders.
And right? the whole group, welders, you name it.
I mean, because
auto mechanics.
I mean, all of it. I mean, you look, and to your point, you look at the kind of the younger generation today, and they're looking at what the cost of college is.
Yep.
And they think to themselves, okay, they're looking at it as an investment, and what's that payoff going to be later down the road? I'm going to spend X amount up front now. I'm going to have all this debt when I come out of school, right? Versus, I cannot tell you the number of moms and dads that I'm visiting with too lately where their son or daughter, they are now much more interested in trade school. One, because the cost of it is a fraction of what it costs to go to a public or a private 4-year university, right? And, just as a great example, just here in Houston area, Waller High School right now has over 500 kids in their welding program, right?
Well, that was another thing we did with our education system is that when I was growing up, I don't know if you did, but when I was in 6th, 7th, and 8th grade, I had auto mechanic shop in 6th grade. I had welding class in 7th grade. And woodworking shop in 8th grade.
Oh, I remember wood shop.
Using power tools and all this. And, today parents are like, stay away from the power tools. But no, we were learning to weld in 7th grade, right? But, we took all those shops out of school and we did away with all those. And I think we really did it a service. I mean, I remember in high school, I took auto mechanic shop in our 9th grade of high school, and our principal at the time drove a Volkswagen Beetle. Remember the old Bug back in the day?
Oh, it's a classic.
Yeah, it's classic. Super simple to break down. And so we actually went out one day during our class and we disassembled his Volkswagen and put it back together in the gym. So he was really upset. But, those are things you can do. But it was interesting because according to ADP data, pay for new hires in construction now outstrips pay for new hires in professional services like accounting. So, there you go.
Again, it's about that investment going into school, right? I mean, when I was growing up, I had wood shop and had all those classes too, and then it kind of seemed that all those, the auto shop, the welding, the wood shop, it all got kind of pushed to the back corner of the school. That you go back there to the back corner, that's where you go for those classes. But today, now a lot of that is brought up to the forefront. When you walk into these high schools, I mean, they want to showcase this stuff.
Yep.
And, now to your point where you're talking a little bit about the AI and robotics, now that's all being married into that, that hands-on work. So they're kind of marrying there's something to be said about building something with your hands, but now they're bringing in the robotics just to make it even more efficient, right?
Right. No, absolutely. And, it's interesting. And today, really, there's a big disadvantage with applying for jobs because it's no longer like it was when we were growing up where, you go into a business and you find the owner and you walk up to him, shake his hand, look him in the eye and say, hey, I would really like to come work here. Are you hiring? Here's my resume. And hand it to them. And, that's not the case today. It's like, submit your resume online. You're in there with 10,000 other people. And, if you get a job, good luck. Construction still, though, does kind of work like that. You can actually go to a construction site, find the foreman and say, are you hiring? Same thing for plumbing, et cetera. So, but anyway, my point is that I think this is a really good not innovation, but a change because we have maligned blue collar work for so long as being something that's beneath us. We all want to grow up and work in an office building and a corner office, et cetera. It's kind of the way we raised our kids. That's the measure of success. You got the corner office in a high rise. And that's the way I was raised. And, that was my aspiration growing up. I want to work in a corner office in a high rise building. And that was the mark of success. But, success really isn't that. It's, what you find out is that over time is success is doing something you love to do every day. And it doesn't matter if you make $1 million doing it. If you're happy, you can raise your family and achieve the goals you want in life. That's what's really important. That's what's really successful. At the end of the day, nobody's going to look back and say, how many dollars did he have, right? It's like, if you're the only person at the burial, that's not really success. If you're surrounded by family, friends, and loved ones, that's a successful life. And so it's good that we're starting to provide a focus back on really the things that are important, but importantly, these basic trade skills are something we've got to have in order to grow our country. And so it's important that we move back in that direction. Anyway, all right. I just thought this article, it's a Wall Street Journal. If you haven't read it yet, it's a really interesting article. It's called Gen Z Plumbers and Construction Workers Are Making Blue Collar Cool. It was in yesterday's journal. All right, come back from break. Got a couple of questions from clients and prospects. We'll talk about those. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny, you know inflation's getting bad. You remember back in the day when strippers used to have names like Crystal and Diamond after something really expensive?
No.
The Real Investment Show podcast.
Well, now you go to the men's club, it's like, welcome to the stage, gas and eggs. So, I mean, you just know stuff's getting bad, man. Inflation.
Same show, your schedule.
Where'd you get this from, Lance? Is this?
I was thinking about this last night. I was like,
at realinvestmentadvice.com.
Because it's on all cash business.
Yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, John. Welcome back to the show, by the way. realinvestmentadvice.com. Of course, is the website. Our latest article on the similarities to 2000 is out this morning. John's got questions.
Always have questions.
I have no answers, but go ahead.
Oh, that we're done.
Yeah, okay. We're good.
All right. No, as of late, I've had a few questions come in, kind of a common theme around, and we have many different types of allocation models and portfolio strategies that we can use with clients, but it kind of seems like a kind of the bellwether or kind of a common investment strategy out there that folks can use is that 60-40 model. When I say 60-40, 60% equity, 40% bond. And back in 2022, when Fed was raising rates, equities were pulling down, rates were going higher, bond prices and interest rates moving opposite directions. So you were feeling it on the bond side of the portfolio too. So 2022 wasn't a very friendly year for the 60-40, right? And as of late, I've had a few folks ask me, well, they're concerned that, well, what if the Fed does keep rates higher for longer? Or what if inflation does tick up higher from here? Does it make sense to still have bond exposure in the portfolio? In other words, is it time to rethink the 60-40? Or another way they may say it is the 60-40 dead? I mean, what do you think?
Well, I mean, it depends. It always depends on time frames, first of all. But so here's the problem, though, right? Bonds have a finite value, right? So if I buy a bond today, then I know at maturity I'm going to get all my money back plus my interest payment. So I have a finite guarantee of payment with a bond. Yeah. Right now, in the meantime, it can go up and down in price. But if I hold it to maturity, I'm going to make 4.5% of my money, right? So, what's your alternative, right? Put it all into stocks. And now you're taking on all the equity market risk. And so at the same time, they're going, well, is the 60-40 dead because I'm looking at interest rates and I'm looking at bond prices. So, okay, great. If you don't want to own bonds that provide you a protection of principal function, what are you going to do with it, right? Put it into stocks or into commodities or something else that has no guarantee of return of principal. And you're going to suffer potentially a downside draw at some point when you have a recession, whatever occurs. You're going to have a market reversion. And so you're going to put your principal capital at risk. Yeah. So, one thing about owning a 60-40 allocation is that the bonds provide a buffer to volatility. And so you just have to ask yourself your question which is, what do I want? Do I want more upside? If you want more upside, don't do 60-40. Do 80-20, 70-30. You could do 100% stocks. We have models that cover that entire range. I mean, you can choose whatever allocation you want based on your risk tolerance, but I think you have to align some of this with expectations for volatility and potential downside draw at some point when a market does a mean reverse. And it's always interesting, right? In June of last year, we were getting these same questions, right? Market's going up, it's the AI chase, and we were like going, okay, hey, there's going to be a 5 to 10% draw at some point. And people are going, I need to be more into equities. And by the time we got to October, it's like, why aren't I all in bonds? And we were just down 10% from the peak. So again, these draws are going to be much more important. I just did I'm writing an article for next week talking about valuations and what would be required to revert the market back to median valuations over time. And, all of a sudden now you're talking about a 30-40% draw. And that becomes a much more important issue to future retirement outcomes. And again, if at 10% people were worried about that, at 20 or 30%, it's going to be a very different story.
Yeah, and I think so. No, I really appreciate the explanation there around bonds. I think sometimes where the challenge is, I think sometimes investors, we lose sight of the fact that even if we own an individual bond and it has a finite length of time, it's going to mature at some point. As long as I hold on to that bond until it matures, and assuming that bond, the issuer, the entity behind that bond, is still solvent, right, and doesn't go out of business, I'm going to get my coupon payments, I'm going to get that cash flow, and I'm going to get my principal when that bond matures. But that bond's price is going to fluctuate while you hold it, right? And I think sometimes, like you just look at the month of April as of recent, when equity markets were pulling down, about 5.5%? Interest rates ticked up a little bit. And of course, in the world of bonds, bonds that have a longer time element, longer maturity, those bond prices are going to move more to changes in interest rates. So we saw interest rates tick up a little bit in April. So if you hold long-term bonds in your portfolio, you go onto your account, you look online, you go, oh man, I see some red on my screen. What's going on? Right. So it feels like you're losing, right? But the only way you would really lose your principal at that point is if you sold that bond early before it matured, right? So, but I think it's just easy for all of us to get drawn into, we see red on the screen. Does it still make sense for me to own this position in my overall portfolio, right?
Well, no, and the best thing I love it is when you hear people talk about, is the 60-40 dead, blah, blah. That's the time that you want to be buying the crap out of a 60-40 allocation. Because, look, there's just some basic economics around interest rates, and the economy's slowing down. As the economy slows down, interest rates fall. As interest rates fall, bond prices go up. I've got a whole article coming out on this Friday. Will be an article, James Grant of Interest Rate Observer,
came out recently, said, oh, we're going to have an interest rate spike like we saw back in the 70s. No, we're not. And I go through all of the economic data explaining why he's wrong. And so that article will be out on Friday covering all of that. The biggest reason is monetary velocity. We don't have the monetary velocity to support higher rates. So, that's, there's over the next 2 to 3 years, 60-40 allocations will likely outperform the S&P just on a raw return basis.
Yeah.
Yeah.
So sometimes when you see various firms, when they're managing, let's say a 60-40, for example, that's 60% that they have in equities. Sometimes they want to own a little bit of piece of every asset class out there. They're going to have so much always allocated to large company growth. Mm-hmm. They're always going to have an amount allocated to large value, small cap, the international markets, the emerging markets.
Yep.
Do you think, does it make sense to own all of these different asset classes all at once just to be quote unquote diversified?
No, because they haven't performed over the last over the last decade. Mm-hmm. Right, starting in 2014. Actually goes back further than that, but really in 2014, but going back to 2010. Emerging markets, every asset class, you pick the asset class. Every asset class has underperformed the S&P and the NASDAQ.
Yeah.
So why, so basically it's fine to own these other things, but emerging markets were the worst performing asset class over that period, followed by small caps, gold, go right up the list. And that's just because money flows are all moving into ETFs. People are more passive indexing, and that's driving those larger cap indexes. And so you're kind of fighting the tide by not buying those assets because that's where all the money's going. Every time somebody buys a stock, anywhere, it flows into an ETF, flows into an index, drives those prices higher. And so there's just this massive performance. And we're not talking about a small performance gap. We're talking about massive performance gaps between emerging markets and S&P 500 and particularly NASDAQ. So just,
yeah. I mean, in the first segment, you were talking about the ETF market, just the growth of ETFs in general, right? I mean, I remember back in 2000, early 2000s, at first there were maybe 3 ETFs and there were maybe 100 at that time. Now you look at today and there's, thousands of them, right? And you look at the S&P 500, you're talking about every dollar that goes into the S&P supports those companies that make up the top holdings of the Standard & Poor's 500 index. I mean, you look at the top 3, Microsoft, NVIDIA, Apple, that's 20% of the S&P 500,
that's right?
I mean, that's huge. So you're kind of, all those other asset classes are fighting against that right there,
that's
right?
That's right. Yeah. So, this is, all part of it. So look, and also it's important to remember that whether it's bonds or whether it's emerging markets, a lot of people go back to the debt, right? And they go, oh, 35 trillion in debt. It's a total misnomer to go look at the debt and this is going to cause interest rates to go up or this is going to cause emerging markets to do better or whatever. The debt has nothing to do with anything other than slower economic growth because the more debt you have, the more it diverts, the interest payments divert productive capital from making a productive investment, i.e. building out a power grid, into servicing debt. That's all that matters. And because when that happens, the more debt you have, the slower your economic growth is. The slower your economic growth there is, the lower your rate of inflation, the lower your rate of interest rates, et cetera, because they all tie to the function of the negative impairment of debt. And when you take a look at countries like emerging markets that have a lot of debt, and are export dependent, particularly on the U.S., as our economy slows down, their economy slows down more. So it's a virtual spiral of slower economic activity. Yes, we have inflation right now because we injected liquidity directly into the markets, gave people checks to spend, and shut down the economy. So you had no supply and all demand. So yeah, you're going to get inflation. That's going to reverse. That has nothing to do with the debt. So you need to leave that alone because it's a false premise that's driven by people going, oh, you need to buy gold because of the debt. They're trying to sell you a product, but that's not how debt works in an economy.
So when you were talking about, slower rates of growth, less inflation, leading to lower interest rates, those are all ingredients that affect yields on especially long-term bonds, right?
Yep.
Yep.
So, all right. What's next when we come back?
Are we going to talk a little bit about commodities?
We can if you want.
Talk a little bit about copper. Are we cuckoo for copper?
Yeah, we can do
cuckoo for Cocoa Puffs?
Yeah. Cuckoo for copper. Yeah, we'll do that when we come back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. I'm your host, Lance Roberts. Of course, John Penn joining me this morning as well. Just going through a few, we get a lot of the same things y'all ramble on about in the chat. Most of this is very erroneous, and most of your comments are not correct. They're fed by the media, and the stuff that you're watching on media is certainly feeding into a lot of this narrative. And I get it, and that's what it is. But there's a lot of factors that go behind a lot of these views and outlooks, right? And so what we're going through today is we're getting the same questions from our clients and prospects that you're posting out on the chat, and this is why we write so many articles on our website addressing these points, right? So, and that way, these articles, when I write them, I can have all the data there. I can show you all the charts that back up the views, and these aren't my views. This is just what the data is saying. I'm not just rambling off stuff to sell you a product, because I don't have a product to sell you. It's important to understand what drives cycles and events and markets and these type of things. So try to let some of this narrative stuff go that people are doing to hawk some product at you, whether it's gold or whatever it is, and look at the data. And again, I don't have anything against anything, right? We have a portfolio that owns gold in it. We have a portfolio that owns Bitcoin in it. I mean, so I own Bitcoin personally, so I'm not opposed to any of these asset classes. If I can make money with it, I'm going to make money with it. That's what I do personally, and that's what my job is as a portfolio manager. So I'm not against any of these narratives. So don't think I'm all stocks and it's just we should only be invested in stocks. That's not true at all. But what my job is to make sure you're educated with the facts that support these views. And when these, views are supportive, I'll give them to you. But again, a lot of these narratives are just that. They're narratives to sell a product, but they're not actually valid, and particularly over long-term cycles. So go ahead.
Well, and I think sometimes all of us, we're all human, we're all wired. It's very emotional, right? And we're just bombarded with headlines, 24 hours a day, 7 days a week. I mean, every day of the year. And I think sometimes we all just need to kind of take a step back and take a breath and just kind of really the narratives are only so much, right? I mean, it's easy to get led by these narratives because, to your point, what do all of these various websites and people want? They want your clicks. They want to sell you your book. I want you to subscribe to this or that. Well, how does this? Sometimes I think we all get so wrapped around the axle about all these things, and at the end of the day, does it really apply to you in your own unique situation? It may or may not, right? So I think we all need to kind of take a step back sometimes and just take a breath and really got to focus on, okay, well, when it comes to investing, there's only a couple of things that we can all control as investors. One, how much risk do we take, right? How much do we spend? How much do we save? And really, maybe we can control our emotions, but as of late, I question that because it just seems like we're all just getting so bent out of shape with all the narratives out there.
Right.
Sorry, a little bit of a rant.
Right. No, that's true. But and again, this just is the point. Is like we want to make the best decision. Look, our job is we have one job, right? To go try to make our money make money. That's all there is to it. And narratives are great. And there's always a narrative for one thing or the other. Gold bugs are great because they always have a narrative, right? The world's going to collapse, and so you got to be in gold. And there's no real support for that narrative at all. Because if the world does collapse today, you better have lead because lead will protect you. And if you've got gold, that's great because somebody's going to come take it from you. And there's no guarantee we're going to go back to a barter system, right? And gold's not a currency. I can't exchange gold until I convert it into dollars to go buy something with it. I can't go down to Starbucks and buy it. So it's not a currency if I can't transact in it on an immediate basis. Now, if we go to a barter system, will gold be the barter issue? I mean, it might be bottle caps in the future. Whatever it is that the world settles on, and honestly, if the world ends, who the hell cares? Right? Yeah, great. You've got gold, right? So what? The rest of the world absolutely sucks. We're all out clubbing each other in the streets trying to survive. I don't really want that. I'm not looking, I know I'm not promoting that type of environment. I do know, though, that since, 1950, if I own the S&P, I'm up 37,500% versus owning gold, I'm up 7,500%. So I do know that, right? And sure, there are absolute periods of time where gold has outperformed stocks on a short-term basis. Absolutely. Mm-hmm. And there's times that gold has phenomenal collapses and you lose 50% of your money. That's okay, right? And again, I'm not opposed to gold. I'm just saying these are all narratives. And there's a time to own gold. There's a time not to own gold. There's a time to own stocks. And there's a time not to own stocks. There's a time to own bonds, et cetera, right? And so it's all about just what can we do to make money with our money, because our job is to grow and to become more prosperous as individuals so that we don't have to depend on others for our well-being.
Yeah, and it's all about balance, right? I mean, like you mentioned, there are a lot of individuals and folks that I visit with on a regular basis where they have some gold or they have some precious metals as part of their overall investment mix, but it's a healthy mix. It's not 40, 50, 60, 70% of their overall portfolio. Right. It's just a diversifier, right? That's it. It's just one piece. And it could also be cryptocurrency. I can't tell you how many times folks may say, "Hey, John, I got a little secret to tell you." I'm like, "Oh, our relationship's about to get really real right now." They go, "Guess what else I own?" "What?" "I own some crypto. I own a little Bitcoin." Okay, that's all right. There's nothing wrong with that as long as it's all about balance. That's okay, right? And just don't let it dry. Your investments don't own you. You own your investments, right?
No, that's right. And I think Larry's got the best comment this morning in chat. Lance gets paid to make money. His charts are better. His charts better be right. I get paid to ramble. No, actually, I get paid to ramble, Larry. That's all I do in the mornings, and then I go home, right? So, yeah, so you and me, Larry, we're both in the same boat. We get paid to ramble. Anyway. But no, this is just, and again, you kind of brought up the point about copper, right?
Yeah,
and copper is a great point. So I just wrote this article on Friday talking about commodity cycles. And we kind of touched on it a little bit yesterday, but copper is great, such a great example. And I used this example yesterday that we're gonna have this huge demand for copper, but there's also a lot of freaking copper already in the world. And I was telling the story. I don't know if you heard the show yesterday.
Yeah.
That in 2000 we were having this, or 2001, 2002. I can't remember exactly when it was. We were having this big copper run at the time. And people were stealing copper out of everything. Stealing people's washers, dryers,
AC units.
AC units.
They've all got gates around them now for that very reason.
Yeah.
And they stole the copper out of our radio transmitter, so we were off the air for like 2 days because they had to replace all the copper wiring. But my point is there's just a ton of copper out there. And so what happens is of course, when copper prices rise enough, everybody starts, stealing copper. There was a great article about this the other day too. AT&T has $2 billion worth of copper in unused lines, transmission lines that they have just sitting around. So again, just tons of copper to bring to market. If prices get to the level, if there's this huge demand for copper, there's a lot out there. And of course, this is why, as we talked about yesterday, commodities regularly boom and bust over time. And it's just a function of that process is that demand is going to create supply. And then when you create supply with that. So, but again, there's a great reason to own copper at points in time, just like I talked about this morning at the open show, right? Oil prices have now gotten very suppressed. Oil longs are very negative. This is probably a good time to buy some energy stocks, right? Just for a short-term trade. So if you're looking for a short-term trade, there's likely going to be a little bit of a lift in energy stocks over the course of the summer. It's also kind of a rotation trade. Energy is the most oversold out of favor sector, I'll say that in a second, in our newsletter this past weekend. So if you go to our newsletter every Saturday, I post a chart down in the technical section of the market report. We post a chart of the most out of favor sector. And those are generally great opportunities because if they're generally way out of favor for some reason or the other, they tend to migrate into being in favor at some point. Remember utilities? Everybody hated utilities. Every week for like 4 months, it was utilities was the most hated sector of the market. Now people can't get enough utilities.
Load me up,
yeah.
Right?
So again, that's how you want to look for things. Look for things that people don't want. If everybody wants something, that's going to bring supply to market, right? And that's a time to sell and take profits. When nobody wants something, that's where you want to start looking to make an acquisition because eventually, and assuming that it's something worthwhile, by the way, if nobody wants something because it's crap, that's probably not something worth buying. But if there's something there, utilities, people have to buy electricity at some point. If that's a really out of favor sector, might be an opportunity there. Real estate might be an opportunity there. Those are the things you want to be looking for to help you make money in the markets.
Yeah, I mean, especially in Houston right now with as hot as it's getting, if we do get into a little bit more uncertain times and folks need to cut back on their spending, they'll cut back everywhere else except for their utilities right now.
That's right.
Right?
Yeah. Larry, you're absolutely right. House fire is not hot enough to burn diamonds. It's also not hot enough to turn human bone into ash. So you need an accelerant for that. So if you're going to hide a body and burn a house, it's not hot enough.
I'm waiting for the sedans to pull out front. What's going on? What are we talking about here?
I'm just responding to comments. Apparently diamonds are you cannot burn up in a house fire. Although I don't know, maybe Larry, you have to check this. I haven't checked it, but will artificial diamonds burn up in a house fire? Because now artificial diamonds have come to market and it's suppressing the value of real diamonds because women are okay saying, yeah, you can buy me an engagement ring with an artificial diamond. And now real diamond prices are getting very suppressed.
Great words of advice.
There you go. Mm-hmm. All right. All right. Thanks a lot. I enjoy your chats. They're a little bit insane sometimes, but I do enjoy reading them. Someday we're just gonna have a chat response session. We're just gonna let y'all ramble and we'll respond to them. We may do that here soon. Anyway, maybe we'll do that next Tuesday with John.
Sounds fun.
There you go. All right. Have a great day. Tomorrow, of course, with Danny Ratliff. Get by the website. Our latest article out today on the similarities to 2000 on the website now, realinvestmentadvice.com. Have a great one.